The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Friday the 15th, 30 to the close. What do you need to know out of Europe this hour? Let's talk politics first. The SPD's Olaf Scholz clearing a major hurdle on his way to becoming the next Chancellor of Germany with a deal with the Greens and the FDP to move on to formal coalition talks. Cleared for takeoff, the United States will reopen to international travellers on November the 8th if they are fully vaccinated. And a car crash. European auto sales for September were the worst in over 25 years. They were down by 25%. The chip shortage is being blamed. Let's talk about the markets where we are. Stocks are bid. Equity markets are flying higher. I use those words because it's the aviation sector that is driving us up. Certainly the best performing sector today as we see news that the North Atlantic will finally reopen. But crude continues to get a bid. Where are we now? Just shy of 85. 84.72 on Brent, Alex.
Well, yeah, what do you need if you're going to come over here to the U.S.? You're going to need a plane. If you need a plane, you need jet fuel. So all of that also helping to boost oil as well. Same here in the U.S. You got the airlines leading the way, hotel guys, also some of the cruise liners leading the way higher. I did want to highlight energy as you see Brent kind of kissing 85. Financials getting a nice bid, really good. Solid numbers continue to come out. The question is, are we at a peak? And you can see that with the UMich numbers. Retail sales might have been good, but UMich, those expectations and inflation expectations lead to a consumer that looks really hesitant. The sentiment index fell to the second lowest level since 2011. On the flip side, you got metals just flying higher. We'll get to this throughout the show. Zinc, the highest level since 2007. Again, you see more factories, smelters shutting down because of those high input costs from natural gas. So all of that leading to higher yields here in the U.S. We're off the highs of the session, but still about 4 basis points. 155 is where we sit here, Guy.
Yeah, yields are getting a lift over here as well. It was interesting after yesterday's big move down, i.e. prices higher. Let's get back and dig into some of those stories in a little bit more detail that I highlighted at the top of the show. Let's first focus on Germany. Aggie Cantrell is watching the German coalition deal starting to be formed, moving on to formal talks. Sid Philip is following the U.S. decision to open its borders to vaccinated international travellers. Craig Trudell joining me here in the studio to break down the EU auto sales. And Anna Shiravyevskaya joining us here with the latest on the UK nat gas price story. Aggie, let's start with you. Olaf Scholz near a milestone in his bid to succeed Angela Merkel as German Chancellor. He was talking a little bit earlier today. Let's first listen to that.
It's been successful. We have decided on a paper, an exploratory text, which will be the basis upon which the parties can come to an agreement.
So Aggie Cantrell joining us from Berlin. Aggie, what next?
So what's happening next, Guy, is that they're going to go into the really official talks. These first were exploratory talks to find out what the red lines for the different parties were. And we did manage to glean some significant focuses for these coming coalition talks where the real negotiations will be happening. For instance, we found out that the Greens have managed to get the other two parties to commit to an earlier exit from the coal industry. It was originally planned for 2038, and now they've managed to push that forward until 2030. And similarly, we've seen the FDP, the more hawkish of the three parties when it comes to fiscal policies, managed to get the other two parties to commit to returning to Germany's constitutional debt limits.
Aggie, thanks a lot. Really appreciate good reporting. Bloomberg's Aggie Cantrell joining us there. And something that got us all excited in our morning meeting because we're like so pumped to have Guy come to the U.S. The entire team is here. The U.S. will open its borders to vaccinated travelers November 8th. So here with more is Bloomberg's Sid Philip. Hey, Sid, can Guy come over here? What will it be like for him? He got the Astra shot.
So at the moment, the US is going to accept all vaccinations that are approved by the WHO. And that would include the Astra jab as well as the other jabs that aren't being administered in the US, but are being offered in other places. So the US is set to lift the ban on November the 8th, and the airlines obviously cheering that decision.
Absolutely, Sid. We will certainly see the airlines really kind of ramping this story up. We're certainly seeing in the share price at the moment. Sid Philip, thank you very much indeed. Let's turn from planes to cars. EU new car sales tumbling over 23%. That's a year-on-year number last month as the global chip shortage reared its ugly head once again. The numbers are epically bad. Craig Trudell of Bloomberg News joining me now on set to talk through what we're learning here. Craig, I called it a car crash at the top of the show. That's what it feels like.
Absolutely, and this makes 3 months in a row. It's also the case now that we've had more down months this year than we've had up months, and it's now looking like we've gone from the industry expecting surely this will be up from 2020 being a disastrous year last year to actually, you know what, we may be down. That's the trend line we're on and the sort of expectation taking hold among analysts. What we saw too was this was just really broad based. It was across the board. Automakers reporting 20-30% declines, and the feeling that the chip shortage is not going to get better anytime soon. There's real concern that the situation in Southeast Asia in particular is going to pose a problem to chip packaging and testing, and that's going to be a real burden on the industry for weeks and months to come.
Yeah, it just gets worse and worse on that. All right, Craig Trudell of Bloomberg, thank you very much. Now let's look on what's going on with European gas prices. Joining us now is Bloomberg's Anna Shriyevskaya. I'm going to get this. Shriyevskaya. Anna, where are we with natural gas prices again this week?
European natural gas prices took a breather from a rally today after Russia said it may resume supplies, offer spot offers next month, but obviously it depends on domestic situation, and also attention shifted to Monday when extra capacity to transit gas via Ukraine and Poland becomes available. And obviously the question is whether Gazprom books this extra capacity to move more gas to Europe next month. But at the same time, the gas prices remain at very high levels. In particular, traders started withdrawals of gas from storage sites.
Yep. Anna, we're going to leave it there. Thank you very much indeed. Wrapping up the wrap of what is happening here in Europe. Fascinating kind of stories all fitting together. There is a bit of a sort of a patchwork of things taking place here. The demand story on the airline side feeding into what is happening with the aviation fuel and then ultimately feeding through into what is happening with oil prices, which then ripples back, of course, into all of the other energy shortages we're seeing. How much of this is inflationary? Are central banks going to have to react? We're starting to see some evidence that maybe there's some pricing that even the ECB might have to move. We'll talk about that next. Thanos Papasavvas joining us. He'll be joining us from ABB. We'll get his take. Where's the euro going? Where's the pound going? There's plenty of factors that we need to think about here. And FX is having a really big impact on returns right now. This is Bloomberg.
I think there are very good arguments to say that a lot of what we see today is temporary in nature. We have base effects, and of course we have supply constraints, but also because it's lasting a bit more, and we know that some of the supply constraint will take some time to abate, maybe a year or so, that it could turn to something that is a bit stronger in terms of second round effects, and there is uncertainty there.
The Belgian Central Bank governor, obviously also on the ECB, speaking to Bloomberg a little bit earlier this morning. Joining us now, Thanos Papasavvas, joining us from ABP Invest, and he's the CIO over there. Thanos, we are now actively pricing the fact that the Fed is going to be raising rates next year. The market's bringing that forward. The Bank of England, we're pricing possibly by the end of this year a rate hike. Inflation is starting to get sticky in a number of different areas, and we're starting to see some evidence that that's also beginning to impact the Eurozone as well. The market is starting, therefore, to think about the possibility of pricing in ECB rate hikes. Is that a step too far?
I think it should not be. I do believe that the ECB have been not very sort of clear on the inflationary message. I think there are some underlying factors beyond the modeling which would suggest inflation is more of a concern. I understand the ECB's views in terms of energy prices or pent-up demand being transitory, but there are some underlying factors, the geopolitical tensions, the wage negotiations, the potential risk of consumer expectations losing that anchoring. So I do believe that they will readjust their expectations and be forced, if you like, to consider a slightly more hawkish environment, especially after the Fed and the Bank of England.
Well, Thanos, that's counterintuitive from what you usually hear, and I appreciate that view. How do you then see break-evens? Like, how mispriced are they? Because German 10-year break-even still at 1.8%. We're well over 2 here. UK is at 4+. How mispriced is that?
Well, I believe that that in terms of the expectations, it's on the timing side. I believe that the market has been slightly complacent on this. I believe that although the expectations of inflationary from the US are a little bit ahead of the curve, in terms of Europe, it's not as hawkish. So I think there could be a little bit of a surprise, which could provide some support to the euro from where we are now.
Okay, that's interesting because a lot of people are talking about selling rallies in the euro, and actually the trend is probably down. You disagree with that?
I do not. I agree with that. We were positive the euro, and we closed that point at 120 earlier in the summer. We are also waiting, if you like, for that correction higher in order to turn negative. I think that the interest rate differentials and the economic differentials will be supporting the dollar over the next few years. However, I would not like to do that. I would not like to turn negative euros yet until we see this correction in expectations from the ECB on inflation, which could take us back to the sort of low 120s.
Do you feel like if the ECB has to make that pivot as the Fed and the BOE are they as aggressive as, or there's still going to be some kind of differential?
I think they're not going to be as aggressive. I think the Fed is slightly more pragmatic in terms of the economic factors. I think the ECB also has to play more of a political role, inadvertently, because of the huge levels of debt, because of the very clear divergence within the council, and the fact that it's managing a number of different underlying countries. So Germany, on the one hand, having a very different underlying requirement on the interest rates, and Weidmann and the more hawkish group pushing. So there's going to be more of a conflict within the ECB, whereas I think that the Fed will fall more in line as we see inflationary numbers remaining sticky, which is what we expect.
Thanos, if this is the case, and actually we are moving into an environment where the ECB, even if it's at the margin, needs to be a little bit more hawkish, where does that leave the BTP market? BTP is trading 104 over bunds right now. Historically, well, certainly over the last 10 years, a very tight spread. Do you think that spread blows out? Do you think that the ECB is going to be in the position to continue to support the peripherals?
I think that's an extremely important point. I think that between the BTPs and inflation, up until now, the ECB has been very much focusing on the BTPs, on keeping spreads tight, on keeping volatility low. I think this trajectory may have to change a little bit if they do start to sense the inflationary figures coming through being more than just transitory. So we could be seeing a potential marginal shift towards inflation becoming more important. And in my view, the sooner the central banks tend to act, the easier it will be for them, and the lower they'll have to raise eventually. I think the concern happens if the market feels that they're behind the curve and they have to overcompensate, triggering a potential recession, but also, in the case of the Eurozone, a slightly further concern and crisis.
Interesting. Bloomberg has reported, and we've heard rumblings, that once the pandemic asset purchase program, the emergency purchase program, is over, that there'll be some kind of new asset purchase program, or that the flexibility that we got from PEP will then move to the traditional asset purchase program. Could we be in a circumstance where we wind up having a hike, but then some kind of permanently looser monetary policy through this bond buying program?
I think, again, very, very key point. I think they will be managing it separately. On the one side, in terms of the bond purchasing, the liquidity, the functioning of the market. On the other hand, they'll be focusing very much on the underlying models and economic data in terms of the inflationary pressures, because the ECB did miss out on the inflation over the last year. Their central case, in fact, their worst case was exactly the same as their central case. They did not expect inflation. And I think they've been surprised by this resilience of inflation and the fact that their underlying models did not capture it. So they're a little bit more aware, but they'll be working on both together. Definitely.
Really interesting conversation. Love getting that counterintuitive view. Thanos Papasavvas of ABP Invest, thank you so much. Guy?
Yeah, we've got a presser taking place. Angela Merkel, I think she's in Belgium. She's making some comments. This clearly is she's on the way out. We've heard the comments earlier on from Olaf Scholz, her current finance minister, soon potentially to be chancellor. Angela Merkel says she expects the new German government to be pro-Europe. I think that probably is hard to argue with. She says intensive talks are, though, needed with Poland to find a solution. Remember that the Polish courts have effectively, Alex, ruled that they have primacy over EU law, a huge challenge. And she is urging the next German government to seek a compromise on some of these key EU issues. The EU needs joint action, she says, to resolve these problems. The biggest takeaway for me, kind of almost going back to what Thanos was talking about, is that Germany potentially could be heading back towards the debt brake, i.e. this fiscal push that we've seen may already be starting to run out of steam.
And that is a hard thing to swallow when you look at what the energy crisis is unveiling also, and just how much money we're going to really have to spend for this energy transition, and how expensive gas prices are right now and power prices because of that. I don't know how you kind of square all those things into one neat peg.
No, I think it's really tricky. Germany needs investment. Germany needs not only investment in kind of hard infrastructure, it needs considerable investment into digital infrastructure as well. And the fact that the FDP are effectively saying, yeah, we can have this coalition, but we need to be fiscally conservative, I think may change the trajectory here. You look at what is happening in the United States. There was this expectation that we were going to have this huge amount of fiscal largesse. That's starting to fade, and you've seen it already starting to show up, taking it back to those University of Michigan data.
Yes.
Starting to show up in the numbers.
It's such a good point. Like, that's the pass-through from politics to the market. That's how you get there, that consumer sentiment. That's a really good point. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm John Hyland. Amazon has appealed a record $865 million fine over the European Union's tough data protection rules. In July, regulators in Luxembourg ruled that the company violated rules through its processing of users' personal data. Amazon has denied there was any data breach. And in the U.S., it's moving to expand travel options for those who are vaccinated and clamp down on those who aren't. Starting November 8th, the U.S. will open its borders to vaccinated foreign travelers. The measures are the biggest changes to U.S. travel policy since the early days of the pandemic. The old system barred most foreign nationals coming from certain places such as Europe, India, Brazil, and China. And it's the first day for some of the strictest coronavirus restrictions in the world. In Italy, you'll need a passport showing one of three things to enter public and private workplaces. You've had at least one vaccine dose, recovered from the virus in the last 6 months, or tested negative in the last 48 hours. The pass is already required in Italy to enter museums, theaters, gyms, and indoor restaurants. And say goodbye to Alitalia. Italy's longtime flagship airline ended flights yesterday after decades of losses and numerous brushes with bankruptcy. The new state-backed flagship is ITA, a much smaller carrier that is looking for an international partner. ITA has bought the Alitalia brand and will use its planes, and now it has to fight off low-cost rivals targeting its home market. And that's the latest Bloomberg Business Flash. Guy, Alex?
It's not quite the same without Alitalia. Thanks, John. Great story to finish up on. It really isn't quite the same. Alitalia, it had many issues, many issues, but obviously this was the airline that carried the Pope. You always saw that happening. That was kind of one of those kind of classic moments of my childhood, the Pope getting off somewhere strange on an Alitalia flight. Always fantastic to watch that. But it's going to be interesting to see how Alitalia slots back into a increasingly consolidated European market, Alex. But now we all get to go across the Atlantic. So maybe that's what we should be talking about.
That's very, very exciting. And I bet you airliners are so happy about that. From the commodity angle, obviously, you take the plane. There's going to be more demand for jet fuel. So there's that positivity there. And it doesn't really sound like, you know, if you're vaccinated, you have to take a test. Like, it sounds like a non-onerous kind of thing to come over, which I really feel like is going to open up travel pretty quickly here in the U.S. When are you going to come? When are you doing it? Mid-September, right? No, mid-November.
We've done September. We're going to potentially do it in November. So yeah, so it's exciting. So I think there must be a huge amount of pent-up demand. But
Hence,
it's going to be
our
interesting to see how this.
about you coming,
Well,
it's
I
dominated
agree,
the whole day.
But my trip in theory is a business trip, though increasingly it's sounding less likely, less like that. Yeah, we're going to a Rangers game. Alex is going to bake. It's going to be fantastic. Oh yeah, we've got to do some work as well. And so I think there's also going to. I think it'd be interesting to see initially whether or not actually this is an extension of the VFR story, which dominated the US. Visiting friends and family. So many families have not been able to get together as a result of that. So many people that are based here that have kids, grandchildren, or whatever it is over in the States, family, not being able to go and see them. So it's going to be interesting to see how they kind of configure the aircraft. And I think a lot of people increasingly are also saying, you know what, actually, we haven't been able to do this for a long time. We're going to go to the front of the plane. So I think it's going to be an interesting mix to start with. I'm not sure initially that it'll be dominated by business travel.
I don't know. I'm starting to hear more and more Wall Street guys talking about taking their first trip to London. And I can only assume if that's starting now and we're able to go to London if we're vaccinated, if that's going to be the same. You'll say, I'm going to take my first trip now to New York. I mean, you could be right. It could take a while.
Yeah.
I just feel like increasingly that's what I'm hearing on the street.
No, that's true. But we've been open for you guys for a while.
Yeah.
So the initial trips were not business trips, I don't think. The initial trips were, I want to go to Italy, talking of Alitalia. I want to go to Paris. I want to go to London. I want to go there for fun rather than work. I think you're right. I think the business trips are now starting to pick up. Schools are back. People are sort of getting back into that groove. I'm not sure kind of going the other way whether or not actually... I think maybe before Christmas, it'll be interesting. I think around Christmas, I think it'll be huge. I think there'll be so many people traveling across the Atlantic to go and visit friends relatives, family, etc.
Well, I also have to think what happens with kids, because we're really close to starting to vaccinate 5 to 12-year-olds, which will help a lot when we go over there. But also with you guys coming here, you know, there's cases outbreaking in schools, secondary schools. Like, how does that factor into it? Because if you want to bring your kids over, but they're not vaccinated because they can't be yet, or because there's an outbreak in the school, like, how do you manage that? Is it more expensive? Does it cost too much?
I've got a really simple solution to this.
Leave them home?
Just leave them at home.
Yeah. We support this.
It's not. This may not go down very well in my house, but I think the issue of vaccinating kids is going to be a huge issue. I also think like half term's about to happen over here. Judging by the number of cases in schools right now, it's going to be interesting to see how many people actually are able to go away for half term because their kids have COVID. The vaccination program is turning out to be a little bit more bumpy than the adult population rollout was. Let's just talk about some of the news before we continue to chat aimlessly about transatlantic travel. The UK's David Frost, Lord Frost, still indicating that he feels there's quite a big gap with the EU on Brexit talks. We're not done with that story yet. Might be easier to go across the Atlantic than it is across the Channel very soon. The close is next. This is Bloomberg. So the Friday session is almost done here in Europe. Equities on the front foot. Wow, what a week it has been. We came into the week, Monday, Tuesday, doom and gloom. Back end of the week, huge pivot on the upside, and that has certainly continued through the Friday session. The FTSE's only up by 0.4%, but the DAX has added another 0.8%, 0.7 for the CAC 40. The FTSE MIB in Milan up by 0.8%. The IBEX in Madrid up by 0.8%. Really solid performances. I want to show you how this fits into the context of the wider story for Europe. This is the Stock 600 this year, and you can see the climb that we've been through. This takes us up into the kind of the mid 470s here. We've had a wobble, but as you can see, this is one of the best weeks. In fact, this is the best week going all the way back to the springtime here in Europe. So an incredible recovery here in Europe. Buy the dip is back, Tina's back. That certainly seems to be the narrative at the moment. So year to date, up by 17%. What is interesting, if you currency adjust it, it doesn't look quite so clever. And we've underperformed the United States once again. Many thought that this was going to be the year that Europe would outperform. It's not done yet, but we are still tracking a little bit behind. Travel and leisure, by far and away the dominant story today. I know these aren't heavy kind of cap stocks, so they're not having, from a points point of view, that big an impact. but from a sector point of view, you can see the rotation quite clearly. The news on the North Atlantic driving IAG up, driving Lufthansa up. I'll show you Lufthansa in just a moment. The banks are up, the retail sector's up as well. You saw what happened stateside with the retail names. Energy continues to power ahead, continuing to want to be one of those sort of big drivers, though as we keep hearing, maybe a little under-owned. Bottom end of the markets, the media sector's down a little bit, telecoms is down a bit, media's Pearson really, to be honest. Huge impact there in terms of what is happening with particularly tertiary education. And that's really kind of been taken very badly by Pearson investors today. Telecoms a little underperforming, utilities, food and beverage. So the more defensive end of the market underperforming quite strongly. Let's talk you through the numbers. Renault, strong day today, up by 3.29% despite those terrible car sales numbers. There's Lufthansa, huge beneficiary of the reopening of the North Atlantic, up by 4%. And Rio Tinto, interestingly, down by 1.43% today. But the metals market, Alex, absolutely on fire.
Totally on fire as we wind up having all those supply disruptions. A large part of that has to do with those skyrocketing power and natural gas prices. So let's get more insight into that with Martin Ratz, Morgan Stanley Chief Commodities Strategist. Is that what is to blame for this huge boost and boom that we've seen in the metal prices? Is it all to blame because of natural gas and power prices?
Yeah, to a large extent it is. But it comes against the backdrop of generally strong demand more than we can supply. For a while during the sort of the heart of the lockdowns, a lot of spending that we all used to do on sort of travel and leisure was converted to spending on goods. Spending on goods is favorable for metals demand. It was our expectation that when the reopening happened, that spending would shift back and we'd go from sort of buying stuff to doing things. We had that strap line for a while, but it just now seems to be strong demand across the board. In the energy commodities, we see strong demand for transportation fuels, but still in goods demand, we still see very strong spending. And it's just we're running up against the world's ability to deliver all these things, and that is tightening across the board, and particularly in the sort of broader commodities complex.
Yeah. Martin, what impact will the reopening of the North Atlantic have on kerosene demand?
Very positive. It's a relatively straightforward read-through. And it is particularly important for really the entire oil complex. So if refiners make gasoline and diesel and jet fuel is a product that sort of sits in the middle. If you don't use the molecules that would otherwise go into jet fuel, you can partly blend them a bit into gasoline and mostly into diesel. So you can use these molecules elsewhere, effectively then increasing supply of these other types of oil products, gasoline and diesel. Therefore, these pools of demand are then a bit oversupplied. What happens when when jet fuel demand comes back? You need to extract these molecules out of the diesel pool, out of the gasoline pool, and therefore also those pools then tighten up. And with that, the entire barrel tightens up. That's really favorable for refining economics, and the refineries start to run faster. And you can see how that would then have a broad tightening of the entire crude market as well. So it's very important.
Love talking about the molecules. You're talking my language here. So is the path of least resistance, say, for oil up? Like, what's the bull case potentially here? If we're already sitting at 84 on Brent.
Yeah, no, look, there are broadly two stable equilibria for the oil price. It's either the oil price needs to be so low when we're oversupplied that it destroys new production. That's the marginal cost of production. That's one anchor. The other anchor, the other stable equilibrium position in the oil market is when the oil price is so high that it destroys demand, which is what we need when we're undersupplied, which is now. So really what's just happened over the last 12 months is that we went from effectively the supply destruction price to the demand destruction price. Who knows exactly what the demand destruction price really is? On the supply side, we can do a lot of analysis, but on the demand side, it's much tougher, particularly under conditions like this, when there is a lot of economic stimulus in the system. People, have pent-up savings, keen to travel. Who knows really what the demand destruction price is? At some point, a couple of months ago, we thought maybe $80 a barrel. There doesn't seem to be much sign of demand destruction yet. I think we can go higher.
Okay. Well, that leads me on to how much higher, but I'd also like to ask a question about gas. So briefly, how much higher?
Look, $10, $15, who knows? It's all possible.
That's a lot. Okay, but that's not going to be small. Martin, let's talk about the gas price here in Europe. It's gone parabolic. There's all kinds of factors in the mix. Hard to get a sense of what's really happening. What is your assessment of the picture? Is the market overpricing kind of the demand story and the supply story and how much Russian gas we're going to get? Are we at the point of maximum pain?
Yeah, for gas, we would say so. So our view is clearly constructive on oil, but we are quite cautious on natural gas. Look, in a way, this is not so contradictory as in the gas price has rallied so much more. Gas is so much more expensive, almost by any metric. Inventories are low, that is true, and that has created a degree of concern in the market that has underpinned this price rally. But we would say they are not so low that it would really threaten sort of outages, even in case of a cold winter. We are very close to the level where natural gas inventories in Europe are actually sufficient to even get us through a cold winter. They're actually, over the last couple of weeks, filling again at better rates. There is already some demand destruction taking place. We saw more news about that even today with several headlines. And then it is also our expectation that in the end, once Russia fills up its storages, more supply from Russia will be forthcoming. We've held that view for a while, but also today there's been some news indicating that that indeed will likely to be the case. So we're more constructive than the forward curve on oil, but we're a bit more cautious than the forward curve on natural gas.
No, fair point. So what's the potential downside if, as you say, we're almost good to go in Europe if there is a cold winter, and then if there's not, if it's just not as cold as we think, what's the potential downside here?
Yeah, look, I mean, natural gas in Europe used to trade $6, $7, $8 an MMBTU. Now we're at 30. We will not fall back to $6 to $7 an MMBTU, but something in the mid-teens, like $12, $13, $14 an MMBTU. Actually, in a month or two, when we have a bit more visibility on whether the winter will be cold or not, will be an entirely reasonable price.
Wow. That's quite a big shift from where we are now. Martin, greatly appreciate the analysis. Thank you very much indeed. Martin Ratz of Morgan Stanley, greatly appreciating your time today. Let's take a quick look at the final numbers. We're done for the week here in Europe. This is how European equity markets have settled. A little bit of a drawback from the earlier highs, but nevertheless, a solid day. Airline stocks up on this story that we are going to reopen the North Atlantic, Alex. All right, coming up, you got investors struggle with that muted loan growth at many of the biggest banks. Want to delve into that? Yes, trading was awesome, but what about that loans? We're going to discuss that with Art Penn, Pennant Park founder and managing partner. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm John Hyland, and you're looking at the principal room. Coming up in the next hour, Morgan Stanley chief U.S. economist Ellen Zentner. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
Live from New York, I'm Alex Steele with Guy Johnson over in London. This is the European close on Bloomberg Markets. Investment banking going through the roof. We saw that on all the earnings calls for the big banks. But investors are struggling, though, with muted loan growth. Joining us now is Art Penn, founder of Pennant Park Investment Advisors, whose firm has invested over $13 billion and focuses on middle market credit. He co-founded an Apollo Business Development Corporation. Also with us, Bloomberg's Shonali Basak. Shonali, I'll give it over to you for the first couple questions.
Yeah, absolutely. Art, thank you for joining us. You know, back to what Alex was really talking about here with that muted loan demand. What's really happening in the real economy such that smaller firms are not seeing the rush we're seeing in a typical debt market?
You know, it's very perplexing that you're saying that the big banks are seeing muted growth. We are as busy as we've ever been in 14 years in the business, and it's driven by a bunch of different factors, including M&A that's driven by potential tax law changes. Prices are very attractive for sellers. So we're as busy as we've ever been. So I'm really perplexed why the big banks, maybe they just don't have borrowers coming to them for capital, because non-bank lenders such as Pennant Park can provide a nice solution in a more nimble, friendly manner.
Well, maybe you can explain what that disconnect is. Why is it that so much of the banking system is not meeting small and medium-sized businesses?
It's been a trend that's been decades in the coming. The big banks really have exited the middle market for a lot of reasons. The capital charges are high based on what their regulators give them. It's a labor-intensive business. The borrowers want nimble providers. They want people who solve their problems and their challenges, and that's why you've seen the growth in the non-bank lender universe. PennantPark's just one of many players, and I got to tell you, coming into year end, we have never been busier. Our investment committee meetings go on and on, evaluating these deals that come in.
And you mentioned that the returns are more attractive, right, than they are in traditional debt markets. So what are we talking about here in terms of returns?
Well, for our classic middle market borrower, we're talking about LIBOR plus 500, 550 to LIBOR plus 700 to the plus. And in some cases, we co-invest in the equity of these companies. Certainly when our debt's going to drive the growth of these companies, in many cases, we want to participate in that growth, and we will invest in the equity. So the package, the bundle of what we can provide is attractive to our investors between the loan that we're making and the equity co-investment that we sometimes make.
Art, good morning. It's Guy in London. Great to see you in the office in New York. You talk about some of the rates that are on offer here. The conversation that we're having with everybody at the moment relates to inflation and that inflationary impact in terms of how that is going to deliver ultimately higher rates. What is your assessment of what inflation is doing to company performances, their credit worthiness, and ultimately what higher rates are going to deliver to the loan market?
It's a great question. First, I want to point out that the loans by and large are floating rate. So as rates go up, the loans should certainly participate to a large extent in the increased rates. So we're in many ways protected from increased inflation and increased rates. On the other hand, as lenders to companies, you're right. How does inflation impact these companies? How does it impact these industries? And what we really focus on are companies that have high margins and that are really important to their customers. We're always asking the question, if this company goes away, does anyone care? And the corollary question would be, if this company raises its prices, do its customers care? Will their customers continue to buy that company's products? And in most cases, that is the case. If you're lending and investing in high value-added companies, the company's customers will accept higher prices. If you're lending or investing in a company that adds less value, that's less likely the case, and those companies could suffer.
So in the equity market, Art, hi, it's Alex. In the equity market, that sort of translated into certain kinds of value stocks and bidding that up while also keeping and buying technology and growth stocks to kind of offset that. And then the weaknesses would be felt, say, in the industrials because they're so exposed to rising costs. In your world, is there a sector that presents the best kind of opportunity to hedge all of that?
Yeah, look, we do invest in industrials, but it's a light sector for us. We're generally investing in sectors such as healthcare, technology and software, government services, consumer, and business services. So we tend to focus on areas where we think there's price flexibility, and the companies can raise prices if need be, because the companies are so important to the ultimate customer.
How are the companies that you're investing in dealing with the supply chain challenges that we are seeing just really plague most of the country? Yeah,
it's a challenge. There's no doubt. There's someone analogized to the Port of LA to Studio 54 behind the Velvet Line. I'm aging myself back decades, but I think you can get the point. And it's dozens and dozens and dozens of ships just waiting to unload. Kind of interesting that it took until just the other day for them to conclude that they should keep the port open for 24 hours a day versus like having a regular 8 or 10 or 12-hour work day. After all these months of supply chain challenges, they should have done that obviously many months ago. But it is impacting some companies, and the companies and their customers have to deal with it. And it's going to be an interesting Christmas for some companies who are going to have challenges delivering their product.
Transitory?
No. It depends how you define transitory. But this challenge is going to be here for a while.
Okay, what does that mean? Is this something that are we moving into an environment where we are going to see inflation being higher, supply bottlenecks becoming more real, energy volatility in terms of pricing? We're certainly seeing some pretty big spikes right now. Are we moving into a more volatile world?
And you could add labor into the mix as well, and the labor challenges. So I don't know. I'm not smart enough to say whether we're moving into a more volatile world, where the world is certainly getting more and more complex, and we need to be able to synthesize all these different elements as we all try to make investment decisions.
Well, while you see this margin compression too, I mean, there's also wage inflation.
Yes.
So how do you prefer companies to be spending their money these days, on technology, on higher wages, or to stave off these supply chain concerns?
Yes and yes and yes, right? You know, you're right. It's this balancing act that companies have to try to figure out between all those different elements. And it's complex. Management teams are going to be challenged. And investors are going to be challenged to try to figure it out.
Oh, it's great to see you in the studio, as I say. Thanks for spending so much time with us this morning. We really appreciate it. It's fascinating to get an idea of what's happening in a market, a sort of segment of the market that we don't spend a great deal of covering. Art Penn, thank you. Sonali Basak, thank you as well, as ever. I've lost track of the number of times we've seen Sonali Basak this week.
4.
I think she deserves...
this week? Like 12.
Yeah, she deserves a few days off after what has been a pretty hectic week. But I think we're done. Goldman Sachs absolutely knocking it out of the park. That ties the bow around things pretty nicely. OK, thank you very much indeed to both of you. This is Bloomberg. So Stanford once again named the top U.S. business school in the latest Bloomberg Business Week Best B School MBA rankings. Bloomberg, as a result, speaking to top alumni all day from that school. Our colleagues Carol Massa and Tim Stennebeck are there. Earlier, they caught up with TPG Executive Chairman Jim Coulter about how he is investing in sectors related to climate change.
We're defining climate as a sector, stretching from the grid through EVs into agriculture. And so if you look at the investments we've already made in this area, I think it will indicate where we're going. We recently made an investment in a company called Form Energy, which is creating grid-scale batteries, the ability to store power not just for hours and miles, but for days and weeks. We've invested in a company called GridServe, which is a EV charging business across the UK. And we're seeing extraordinary opportunities across everything from the software that will enable this energy transition to farther out issues like carbon capture and direct air capture.
That was TPG Executive Chairman Jim Coulter talking to Bloomberg's Carol Master and Tim Stennebeck. Later on, they're going to be speaking with Carlos Brito and also a top executive from Peloton. So don't miss that. You can tune in to Bloomberg Business Week's special coverage for all of those investing opportunities. And I have the feeling, Guy, that talking about how to invest in the green energy transition and climate change will be a huge topic for all of these investors. I feel like that's where the money is going to flow into. It's just a matter, I think, of what kind of returns you wind up getting and what you have to pay up to make those investments, considering that's the hot thing right now.
It is, but it's interesting. The science is very unproven in some of these areas.
Yeah.
It was interesting here to hear him talk about direct air capture. That is an area of science that is unproven right now, you could argue, from a financial point of view. You can do it, the mechanics work, but doing it on a scale that makes it financially viable, I think the jury is still out on that one. So there's a number of areas at the moment that I think it's going to be a wide funnel to start with. And everybody's ultimately going to figure out what works as you go down and work your way through this process.
So talking about direct air capture, this is what I find so interesting about Occidental, because they've been really into carbon capture for a long time, and they're going heavy into direct air capture. And I asked the CEO a while ago, like, what company are you going to be in 10 to 15 years? And she was saying that they're not going to really think of themselves as an oil company. They're going to sort of rent that direct air capture out as a service. So they can take like a module and like move it around to different plants or industrial sites and just start picking out the carbon out of the air. And that's going to be an easy way for them to make money. And like that's the kind of business model they're going to have. But that's not going to happen tomorrow.
No, but doing it at that scale economically, we don't know yet whether or not that's going to be viable. And maybe better science comes forward and provides a better opportunity. I don't know. That's the problem at the moment with all of this stuff. It's a scattergun approach, but you need to throw significant amounts of money at all of these different areas to figure out what's going to work. It's a bit like the tech race, isn't it? It's a bit like the arrival of the internet, and you just kind of a scattergun approach. Figure out what works, scale that, go.
It's because,
I suspect that's going to be the model.
I'm going to make fun now about you being dated, and because you're old, so you remember that. Anyway, I can't miss that opportunity.
Yeah.
Coming up a week ahead, there's a lot happening too. There's a Milk and Global conference. It's going to be super fun, kicking that off on Monday. Full coverage pretty much all week of that. Senate's back in session. Tuesday, you start to get the tech earnings guy. You got Netflix. Also, you got J&J and United. And then the Fed Beige Book. I always love that one, kind of digging into the details of different regions.
I'm quite interested. The ECB's got a professional forecaster survey out next week.
Ooh.
I'm going to be fascinated to see what comes out of that one. A lot of global flash PMIs coming out, as you say. We'll watch that. As you say, though, maybe the focus is on what happens with big tech. You've got American Express as well. Southwest back end of next week as well is going to be really interesting. That wraps up the week. I hope you've enjoyed spending some time with Alex and I during this week. Ellen Zettner's joining David on Balance of Power. We're going to radio. This is Bloomberg.